is my team, Julian, Diana, Argir, Krisnik, and Visnik. And as the last team, we're also going to present another financial crisis, which was the second biggest one after the first that they explained the Great Depression. So this is what we're going to talk about through the presentation. First is the problem, the causes, the impacts, how should we prevent it, and the last is the conclusion. Some key terms that we are going to mention throughout the presentation are mortgages, frozen credit markets, and subprime lending. To explain these terms, first I'm going to explain to you the simple banking system. A bank takes its money from a federal bureau or some other financial group, and then it lends to people. While it lends to people, people give a promise that they will pay back more, but after some time. But bank doesn't really care about people promises, so it takes mortgages, hypothec in Albania. Frozen credit markets is a time of credit markets when no one wants to buy or give or take a loan, so the whole system is frozen. And subprime lending is like another system of lending where the rules are not taken really seriously, and this is why the most important part why the great financial crisis happened. I'm going to talk about the introduction, the global financial crisis, some history, the problem, and the housing market bubble. First of all the history starts in 2001, when the chairman of the Federal Financial Bureau of the USA decreased the interest rate in only 1%, and they told in order to make the economy grow faster and boost it. And the main problem is that during this financial crisis, a chain of events happened, and it almost destroyed the entire economy of the whole world. And now let's talk about the market bubble. Market bubble is not really a bubble, but that's what you call it. Here we have four main factors. It's people who want to buy houses, banks, bank investments, and investors. First of all, we will start with simple people and banks. Banks take their money from another agency and then lend to people. When people get their money, they buy a new house, and the bank owns their mortgage. So if they don't pay the payment, then the bank can take their house and then sell it to cover its expenses. But then another player comes in, the investment bankers. Investment bankers want to make more money, and also bank does not want to take the risk of the loans, so it sells the mortgages to the investment bankers by a fair amount of price, and they make their money without any more problems. And what the investment bankers do is they take a lot of like 10,000 mortgages and they put them into a box. It's called the CDO box. And that CDO box, then they take it and they put some magic in it and divide it into three parts: the safe box, the OK box, and the risky box. The safe box has the lowest interest rate. The OK box has a little bit higher, but it is still the same interest rate. And the risky box has the highest interest rate, but if everything goes well, the most profit is from the risky box. They are rated like, the safety box is rated AAA, the OK box is rated BBB, but the risky box is not rated at all because no one wants to deal with the risky part of the. And then we have the investors. Investors, as we know, are people with a lot of money, and they want to invest that money and to duplicate it and make more of it. But that's not really simple, because when the interest rate of the Federal Bureau dropped to only 1%, they could not buy treasury bills from there, so they decided to join the banking cycle. So here, when the investment bankers took all the mortgages, they divided it into three parts. So the investment bought a part of it, and then they invested into them, and they took every month some payments, which when made together, they made a huge profit. And the problem starts here. So now you guys are going to continue with the problem.
Alright, so I'm going to talk shortly about the causes of the crisis that happened and started officially in July 2007. Of course, in economy, there is no general consensus on definite causes of crises such as this. But at the end, they try to reconcile, and this what I'm going to present is sort of the prevailing theory, and it's not, of course, accept it 100% as a theory, because there's always dispute on these issues. First and foremost, as my friend mentioned, there was a huge, because the economy was doing well and because there was a stable growth and there was a very stable recession as well. The idea that, as we know, when banks lend money, there is a multiplier effect going on. Keynes says hello, and lots of money is being created. And in this situation, the banks were, by what is called subprime lending, and that Lorik mentioned, the banks were giving lots of subprime lendings. As much as in 7 years, they doubled. In 7 years, they doubled the amount of money, amount of debt that in general. And this is the graph from 2009 to 2014. Just go back. Yeah, back. Yes. So it became very easy to get a loan. It was not necessary. This is why there are subprime loans. You don't need to be very secure. This is the risky part. The risky box, because you make lots of money out of that. Because if I go to the bank and I'm not fully eligible and don't have full, I don't have a real mortgage, a real security for the loan, then of course I'm going to have a higher interest rate on the loan I pay. And this is what happened. So it was easy to get a loan. There was high demand to get loans. But loans, housing loans, because 31% of the whole this money that was created through lending, through the multiplier plan, went to inside the financial market. That is to say, 31% went to buy houses. So it was easy to get a loan, high demand for a loan to buy houses, and thus the price of houses went up. So there was a pushing up of the prices of houses because it was easy to get one. And when I say that there was high demand for houses, I don't mean that all of a sudden there were more homeless people, but not necessarily. People wanted to buy more, their second house or a bigger house, and so on and so forth. All of this on debt, all of this from the bank. And so this is the situation we had so far. Only 8% of this money that was created left and went to some business which was outside of the financial system. So lots of money were being injected in the financial system itself. Now, of course, when we have high risk loans, there came a situation where the persons who took the loans and took the houses from the bank did not have any more, the money to pay back. And this is a situation where the bank comes and takes your house, of course. And this is what happens. The owners were unable to meet their mortgage payments, and this is what is referred to as the subprime crisis. Next. The explosion of the bubble that Lorik explained earlier is that, as I mentioned, the banks repossessed the house, so there was a massive amount of bad loans. That is to say that the banks now had lots of money, lots of houses, but didn't have enough money. So the deposits weren't meeting with the money that they were lending, that was going out of the bank. And so what happens is that there is a price shock in the real estate. Because now the bank has lots of houses but no money, so there is a surplus of houses, then the price all of a sudden goes down. So the banks now have houses that, for example, costed $200,000, $300,000, and now, because the price and the value of homes went down, the banks found themselves with tons of houses that were worth today than what they were, when the loan was landed. And so did also the other borrowers who were still paying. So here's the situation. I borrowed $300,000, I bought the house. The house I live in now is not worth even half of that. So even the lenders who were paying decided to leave and rather to give the house to the bank than to keep paying, and so the crisis deepened. So yeah, the banks and the borrowers who still owned the house found themselves with negative equity. Negative equity is what I explained just now, that the house you have now is worth less than it was when you took the loan. And so there was a liquidity crisis. There was a liquidity crisis because the bank did not have enough money, and did not have, because they were full of houses and they did not have enough money. That's a liquidity crisis. And so giving and obtaining loans was difficult because of the subprime lending crisis that I just mentioned. And this is oftenly referred as a credit crunch. So this is where the bubble exploded now the banks, of course, refuse to give loans. There is a huge shrinking economy. There is a huge shrinking economy in consumption and everything. When the Lehman Brothers goes bankrupt in 2008, because it was one of the biggest banks in the United States, if not the biggest, a new phase of the crisis entered, because now the government sort of, officialized the crisis. The crisis was now official, and the government had to intervene, and that's what the government did. It intervened, it injected a lot of money, it bought the bad loans. In other words, it injected again money in the financial system again. Remember, we said that all of the money that was created from the new loans remained in the financial market. This government intervention was effective only when legislation changed. It was not effective immediately. And this was done through AIG Security Group, American International Group, which is the biggest company, the security company, which was involved in this. So the government paid this security company first, and then the banks, through this the banks, and then recession followed. Now, an alternative theory, or not an alternative theory, but an alternative explanation of why it happened that people were sort of banks were giving lots of loans and people were taking lots of loans. How did this happen? What made the banks act like this and make this decision? It's a theory that emphasizes the excess of saving over investments in emerging market economies, current account surpluses. That is to say that globally, they noticed that there is a huge amount of people are saving more than they are investing. And so what this happened is that globally the rates went down. The interest rates went down. Yeah, I'm going to be soon finished with this. Downward pressure on world interest rates, and the flow of savings fueled the credit boom and risk-taking in advanced economies, in particular in the US. And that's why they took crisis. They took lots of loans.
Hello, I'm going to talk about the impact of the global crisis that happened during the 2008. First of all, I'm going to explain the domino effect. The domino effect is when something starts to crumble, other things continue to crumble. This happened with the world during the problem with the mortgages in USA. As far as we know, the USA is the hegemon. At that time, the USA was the hegemony of the economy of the whole world. So the USA had the most impact in the economy of the world. So at that time, USA was in a crisis, and the way to get out of the crisis was to get loans from other states. But as far as we know, if a country, let's take an example, if a country A takes a loan from a country B, their debt is going to increase. So their national debt is going to increase. Their national debt against private banks and against other countries that they took debt. So outside their country. By doing this, their debt might increase and their interest might crumble the country. So the country B, let's say that the country B has another debt against the country A, but so the country A lends from country B. Country B gets that money, but it needs to pay the debt to country A. So they pay the money, but now both countries are in a recession. No one's winning here in this situation. So both countries stay in a recession during this time. The overall global impact. As far as I've read, I've seen that during that time, 2008, the G7 states, the highest nation with the highest debt was Great Britain, which had a debt of 400% more than their GDP. So 4 times their GDP was their debt. The second one was France with 176%, and the third one was USA with 100% of their GDP. So they had twice of their GDP they had the debt. Wall Street. Wall Street, as Derek explained earlier, the houses that were sold were done by a contractor. So the Wall Street might be the contractor in our case between the businesses and the people. So the lenders and the donators, or how to explain it better, or the investors. So the Wall Street was created I don't remember the date, but was created to complete these contracts between investors and businesses. Wall Street didn't do much during the crisis, but it came up after. It came up to have high importance after the global financial crisis of 2008.
Hello, I'm Fisnik, and I'm going to explain more about the consequences of the global impact of the financial crisis on the global market. Now we know that every action has a reaction, so we can see that lack of cash flow was the first reaction that was caused by the global finance crisis. We were seeing houses getting sold by digits and people paying also with digits. No one was having cash money to pay about their mortgages and things. So when there's no cash out in the market, then we can see that we will have a recession. A recession means that there will be unemployment on the market. What unemployment, it doesn't necessarily mean that unemployment will bring just bad housing debts or just less spending. It also had, to some extent, had an impact on the familiar relationships in the people. So it started breaking moms and dads apart from each other. Preventions. In this aspect, we're going to talk about how to prevent another global financial crisis, although great economists are foreseeing another financial crisis in the year of 2017, so next year. How can we prevent it? First, the false market evaluations. I don't know for you, but I saw the movie The Big Short. It's a quite long documentary about the financial crisis. And there it says that investors and market brokers were creating false evaluations about the markets. They were saying that people are paying their loans while no one was paying. We've heard Derek explain about the boxes, the AAA, BBB, and the risky boxes. Now let's think of it this way. We have 3 boxes. And we have a product that we should put it on the risky box. At that time, from 2005 to 2008, the brokers took the product that was supposed to be on the risky box and put it on the safe box. That was an evaluation. It's everything all right with that, but it was not the real one. So the evaluations were public for the people, so they could see that people were buying houses and paying their loans on time, while it was not the reality, and the number of bad loans was just increasing. We came to a conclusion that this was created by delusion. The American market of loans was so strong that made brokers think that people could pay at any time. That was the problem that made this to exchange the boxes for the brokers. And the lessons learned? Well, we saw that up to 5 million people lost their houses, and also they lost their jobs. Maybe some of them committed suicide. I know it's about 60. I read about that. It's a curiosity. And we can see that another false evaluation of the market, which should have been regulated by law, should not happen in order to not have another financial crisis at our time. Thank you. Now, my friend Fisnik will continue.
Financial crisis in Kosovo is evident. People talk about it, and why? Main state possessions are taken from people who are not adequate. Kosovo is positioned as 144th in GDP ranking according to International Monetary Fund. Kosovo is a country whose budget comes around 84% from taxes according to a financial report of Kosovo Assembly. Unemployment rate in Kosovo is 60% for youngsters aged 15 to 24 years old. Students after their 16 or 18 years of studies cannot find jobs and still depend on their families. The financial sector of Kosovo is one of the newest financial sectors in Eastern Europe, whose development started in early 2000. Factors of the crisis in Kosovo lie in the inadequate management of the financial institutions. The pension system in Kosovo is greatly influenced by the global financial crisis. The trust had left without a board, and as a result, the assets of the trust fell to 251 million euros in relation to paid contributions, which were in the amount of 315 million euros. According to a UNDP report, donor countries have shown hesitance to increase aid in Kosovo due to their internal problems. The rapid increase of unemployment in Europe and North America have affected negatively the Kosovo diaspora. So a decrease of money supplied from the Kosovars working abroad have affected negatively the economy of Kosovo as a whole. According to a regional newspaper, students of the 9th year in Kosovo have shown the greatest success in two courses, American English Language and Technology. With professional training, students could offer a lot more in whatever field of work provided to them. Students can offer much more than thought.
So I will make it a little short because my friend very well explained how the global financial crisis happened, what its impact was, and how it was caused, and what we are dealing with now, even in Kosovo. So first off, let me start by saying that the global financial crisis is considered as an embarrassment for the economic theory, since the economic theory provides an outlet for research in all our areas of economics based on rigorous theoretical reasoning and on the topics of mathematics that are supported by the analysis of problems. There have been three beliefs from the economists, which have been the conquering of severe business cycles, that Julian mentioned. Then we have that the economists thought that there was no regulation required for the constraining of self-interest from the different businesses and firms. And the third one is trusting companies to monitor their own behavior, which all of these three beliefs have conducted to be inaccurate. But on the other hand, the economists justifiably believe that as a process of creative destruction, capitalism requires institutions that allow for innovation and the reallocation of resources toward firms that have successfully been innovative. With creative destruction, we understand that the mechanism by which the new products replace the old products, but the outdated ones, and therefore they are giving hand to the firms which have been very innovative and have shown success. And this suggests that we should not condemn wholesale, even if the financial innovations that played a role in the crisis and which have been but have been remarkably productive. Will continue and will continue to be if we just give them the right regulations. Nor should economists hesitate to say that political reactions to the crisis that hamper such innovation and reallocation may do more harm than they do good. Well, thank you for your attention.
Should you have any questions, remarks, or thoughts? You're welcome. And on the issue of timing, we're 6 people, and I believe that ours is the biggest group, and that's why. And this presentation lasted 28 minutes.